What's going on, guys? Welcome back to another video. So in this one, we're going to be going over how there is a $1 million opportunity out there over the next year and a half that nobody is talking about, and I really want you guys to understand. There have been some really key developments recently with the Federal Reserve, rates, bond yields, and everything of that nature that I'm sure a lot of you guys are aware of. We're going to take it a bit further here and make sure that you guys have everything that you need to know to be able to identify this opportunity when it happens. And we're going to go over examples of essentially what has happened in the past. We're going to go over this whole situation here. Now, this is going to be a little bit more macroeconomic here, guys, but this is crazy important information that you need to understand. Now, I have recently made a video about this situation in the past. The timeline is still exactly spot on for when I think that this is going to start firing off. For those of you guys that have been around the channel for a while, it is TLT. And the last time that we made a video about this in last November, we bottom ticked the chart before it went on a nice little rally there. I'm here again to break down the situation, give you guys an update, everything that you guys need to look for this potentially multi-million-dollar opportunity. So guys, again, if you do enjoy this video here, make sure you guys hit that like button, comment down below any questions that you guys have, and make sure you subscribe for more. But without further ado, let's roll the intro. Now, before we go any further, guys, if you are looking to make consistent money in the market, or at least learn how to, make sure you guys check out that link down below to trade1348.com, the absolute best place to come and learn to trade. All of the curriculum videos are at your disposal, the artificial intelligence algorithms, all of the alerts, all of the real-time unusual options activity. You guys definitely do not want to get left behind, but we have a special offer going on right now that is not going to last forever. You get your first month free with code GAINZ, G-A-I-N-Z. Make sure you guys check that out, link down below if you guys are interested. Now, if you have watched my previous TLT video, we did go over a lot of what we needed to see out of the market in order to make sure that we are in the best position possible for this type of trade. Now, what did we say in that video? Now, I'll link it down below, but what we really said was we needed to see two things: bond buying, rate cuts, and when could this potentially happen? Well, the estimate that I gave last November was the end of 2023 or the beginning of 2024, and we finally have a new update. So let's go over it right now and break this down super simply for everybody. So the United States Treasury announces the first buyback scheme in decades to boost liquidity. The Treasury Department on Wednesday said it would repurchase United States government debt next year for the first time in decades in an effort to boost liquidity, which is a very, very key term, in the $23 trillion government bond market. The program would allow the Treasury to buy back older bonds, which are typically harder to trade from primary dealers, banks that act as market makers for the Federal Reserve, and help improve functioning in some corners of the market. Now, directly from the United States Treasury right here, based on feedback from a broad variety of market participants, including the Treasury Borrowing Advisory Committee and primary dealers, the Treasury believes it would be beneficial to conduct regular buyback operations for cash management and liquidity support purposes. Treasury anticipates designing a buyback program that will be conducted in a regular and predictable manner. Initially sized conservatively and not intended to meaningfully change the overall maturity profile of marketable debt outstanding. Now, when we think about this right here, we're going to go over this a little bit further, but when we take a look at this right here, what is behind the drop in Treasury market liquidity? In a year shrouded by turmoil, 2022 has been one for the record books. Financial markets have been upended by historically high inflation, soaring interest rates, dissolution in global trade, and conflict in Ukraine. YouTube, I swear, if you mess with this video because of that right there, we're talking about bonds and investing, not that nonsense. This has led to volatility affecting all corners of the financial markets. Now, what you have to think about is that when there's less liquidity, you typically can see more volatility, as you guys see right here. Now, what I want you guys to realize is that not everything that you see in the financial media, I feel like that's pretty obvious at this point, is what it seems. You have to be able to look into the market and look into these things that are being projected to you and pick out those key nuggets of information. So this is going to be just an example right here, but the CBOE 10-year Treasury note volatility futures, this is discontinued, but you can see that back in 2020 had a drastic spike up here, showing that there was a lot more volatility than average in the United States bond market, and then it has since settled down. Well, this has been discontinued. The last date of this was in 2020 in June, but what are we looking at now? This is the CBOE 20 plus year Treasury bond ETF volatility index. What does this remind you of? TLT. Now, what do we see with this volatility index right here? We saw a spike in 2022 here. Let's go back 3 years to make this even more drastic. We saw this spike all the way up in 2022. We saw this spike in 2021, and then we go back 5 years and we can see that drastic spike in 2020 when the Fed ended up having to step in, turn on that quantitative easing, and now we are where we are right now with all of these rate hikes in fears of a recession. So if we know that volatility in the bond markets is relatively low right now, well then why is the Fed doing this? Well, it's pretty obvious. When we come over here and take a look at what's happened recently, and all of you guys know this situation, Silicon Valley Bank, First Republic, all of these regional banks have been having problems because they put these deposits that customers were placing into these banks, into these United States Treasury bonds. And something that you guys have to understand about these Treasury bonds is that when yields go up, the values of these bonds go down. Yields and bond prices are inversely related. And we all know that Powell was telegraphing his move basically a year and a half ago when we started to raise these interest rates. Well, they're starting to do the exact same thing with some of these kind of statements that signal when they could be potentially backing off. Now, in addition to this, something that we have to note is that JP Morgan and a lot of these other big banks are not immune to these treasury bond movements or volatility. So JP Morgan Chase today, which was on May 1st, announced that it acquired a substantial majority of assets and assumed the deposits and certain other liabilities of First Republic Bank from the FDIC. In carrying out this transaction, let me bring this up over here so that you guys can see this. In carrying out this transaction, this is a notice from JP Morgan. JP Morgan is supporting the United States financial system through its significant strength and execution capabilities. As part of the purchase, JP Morgan Chase is assuming all deposits insured and uninsured, meaning that they are assuming all of the risk that these regional banks had. Now, there is no signs at the current time, we're in the beginning of May right now, we're kind of getting into the middle of May, that we are going to be backing off rates anytime soon, which would increase the value of these bonds. So JP Morgan has their own deposits. They've now taken over, let's see here, First Republic Bank's deposits. So they are still going to be on the hook for all of these deposits. Well, the Fed is telegraphing some of these moves here. And as we get into the end of the year, also something very, very key to note, guys, and we haven't talked about this in a while, is that a lot of these treasury bonds, there is an issue with the banks right now. But a lot of these large financial institutions, hedge funds, things of that nature, managing other people's money, they use treasury bonds as collateral. It's qualified as, or it's labeled as high quality collateral. So if the values of these bonds are going down, well, then they just get margin called after margin called, which could end up having them purchase more bonds anyway. Now, when would this actually happen? Well, coming to the end of the year here, you guys can see Citigroup hikes 2023 global forecast, but sees U.S. recession only in Q4. Well, when was this notice of bond buybacks? Well, when we come back to this page right here and we scroll down a little bit further, they're looking to do this in the start of 2024. Let me see if I can actually find the exact quote for you guys here. Scrolling down a little bit, it is 2024. Let me actually pull it up in here. Yeah, so given various operational and design considerations, the Treasury expects to begin a regular buyback program in the calendar year 2024. Now, when in 2024? Well, we don't exactly know. The current estimates is the beginning of 2024. So, how does this bring us into TLT and why is this important? Well, when we were talking about those bonds and which bonds they could potentially be buying, remember, we tied this into the volatility index that we were seeing over here of these 20-plus year Treasury bonds. What is TLT? TLT, iShares 20-plus year Treasury bond ETF. Now, you can see that this thing has been trading in a relatively tight range between about 98 and 109 over the last couple of months here. Now, the last video that we made on TLT was right around this range right here, but I want to show you guys what happens to TLT when these big situations happen in the market and why this could potentially make you guys millions of dollars. When we scroll back a little bit further, remember the volatility spike that we were talking about in the bond market? right here, you can see this spike in the CBOE 20 plus year Treasury bond volatility index here. Well, you can see the exact same thing painted out on TLT. Now, again, those of you guys that are on the Trade 1348 platform, you guys would have gotten alerted on this daily traffic light here right around 138 and would have been able to ride this thing all the way up to the highs here. So again, if you guys do want your free trial of this platform here, make sure you guys check out that link down below with code GAINS. But this move, you have to realize that these bond ETFs are not supposed to move. They aren't built to be these very, very volatile metrics. Remember, bonds, guys, are not supposed to be very volatile. So when something happens in the market, i.e. a big pivot, a rate cut, buying bonds, turning back on that money printer, which is always a possibility given this administration and all the other administrations to follow. This type of situation could easily happen if the Fed overcooks things to the other direction. So what we're seeing right now is the United States and the Federal Reserve raising interest rates. What Jerome Powell has said most recently is that, yep, they've raised rates by 25 basis points. We were doing those jumbo 75s. We moved it down to 50, and now we're back down to 25. Right now, the Fed is very data dependent. And what I want you guys to understand about this is going to take a long time to play out. Am I buying TLT right now? No. I need to hear those magic words from Powell, and I need to see what they're doing with these bonds. As soon as they start buying bonds, they are telegraphing their move to you where you should be putting their money or your money. There's very, very few situations like this, guys, that happen in the market, and you have to be really prepared for them. This does not happen very often when these bond yields are going to potentially freak out. Recently, I believe it was the beginning or at the midpoint of last year at some point, we did see the gilts, the United Kingdom's treasury yields, really start to freak out because of the issue that they had with their pension funds. So again, these situations are going to happen in pockets, but you have to understand what we're looking for. We are looking for rate cuts and bond purchases. So what I really want you guys to get about all this information, and again, if you have any questions about any of this, make sure you guys drop a comment down below, is that the Fed is going to telegraph their moves. Remember, as soon as Jerome Powell said the words tapering of asset purchase back in, I believe, November of 2021, we saw the market top a few weeks after that when people really started to digest that information. So again, like I said earlier, there are going to be these key nuggets of information. This is the second video in this kind of series here where we are talking about TLT. Again, technically looking at the chart of TLT here, we are looking for that break of the 200 EMA, a daily traffic light to the upside, but these are things that you guys are all going to get alerted of on the Trade 1348 platform. So guys, that's going to wrap up this one. If you guys did enjoy the information and analysis that I provided for you guys in this video here, make sure you guys click that like button down below, drop a comment, subscribe for more videos like this. Other than that, team, peace.